Forex versus stocks. Hello, and welcome to our channel Pursuit of Wealth. This channel is your ultimate destination for learning about finance and wealth, investing in crypto, informational and educational trends in finance management. If you are someone who wishes to become wealthy and are looking for smart money management options, then we are fortunate to have found each other. With a lot of trading and investment options available today, it became more difficult for traders to choose the best for them. Well, if you are a trader and want to make money, but you are confused between Forex and stocks, don't despair. Because in today's video, you will learn the essential factors that make Forex and stocks vary from each other and will help you understand which one is better for you. So, without further ado, let's get into the video. So, what's the difference between Forex and stocks? Let's start by understanding both Forex and stocks. The first distinction is self-evident. You're in the business of trade. Forex is the largest global market, with a daily average turnover of $6 trillion in Forex transactions. The Forex market is where one currency is transformed into another in the currency market. For example, Forex traders may purchase a foreign currency while traveling overseas or trade the Great British Pound/US dollar currency pair when trading Forex. On the other hand, the stock market is much smaller in value and is where a stock trader is involved in buying and selling ownership in a firm. The value of stock trading is currently around $200 billion every day. Stocks are the units of ownership measurement, and you can start trading stocks on exchanges like the New York Stock Exchange. Reasons to trade in both stocks and Forex. You can select between trading Forex and investing in stocks once you've learned how to do both. There are a lot of factors why you should trade Forex rather than stocks or vice versa. Also, there are various reasons why organizations that offer Forex trading on major currencies can trade US dollars/Japanese yen or Great British Pound/US dollar more frequently than companies listed on different stock exchange markets. Trading hours on the stock exchange. The Forex market is truly global because it can be accessed from anywhere globally, and major currency trading is open 24 hours a day, 5 days a week. Day trading can occur across many time zones, which means that when one zone closes, another will open. For example, when trading in London closes, the Sydney market will be fully operational. Market zones can also collide, resulting in a mixture of activity for Forex traders, such as when London and New York trading hours collide at 9 a.m. New York time. In the meantime, the currency market is open approximately 24 hours a day in various areas of the world, with trading hours in India ranging from 9 a.m. to 5 p.m. Because Indian traders may readily take positions in the foreign currency market, they can trade at any time in the day, making Forex trading a much more time-efficient option. Most brokers are open from 5 p.m. EST on Sunday to 5 p.m. EST on Friday, with customer assistance usually available 24 hours a day, 7 days a week. You can trade during US, Asian, and European market hours, allowing you to create your trading plan. Pairing of trades. Forex trading or currency trading is always pair-quoted in currency trading. Not only can you determine the economic situation of the country whose currency you are dealing with, but you must also consider the economic parameters of the country. Forex markets are sometimes more sensitive to new political and economic developments in other countries. Although the stock market in the United States is not immune to political events, it is typically less susceptible to geopolitical crises. Volume. You cannot overlook the disparity in trade volume: $6 trillion versus $200 billion. Forex and stocks have no competition when it comes to pure market volume. The increased trading volume does provide significant benefits. Orders are typically executed much more quickly and at a price closer to what the trader wants on the largest financial market because of the high volume. The amount exchanged in a certain period is called volume in both markets, which is usually 1 day. You may be recalling the $6 trillion transacted in the currency market versus the $200 billion traded in stocks previously mentioned. Well, traders will find it much easier to get their orders filled at their preferred price level in the Forex market because there are always buyers and sellers depending on volume. Traders may find it more difficult to get their orders filled at a precise price for stocks. As a result, stock market trading may be more complex than trading in the FX market. Enjoying till now? Please hit the like button, share, and comment, and yes, keep watching. Liquidity. Both Forex and stock markets are quite liquid. Still, the Forex market has an advantage because it is the world's largest and most liquid financial market. This implies that massive amounts of currencies may be bought or sold without producing too much price movement. When there's a lot of activity, there's usually a lot of liquidity. With increased liquidity comes tighter spreads and cheaper transaction costs. As a result, Forex spreads are substantially less than stock spreads, implying that the bid and ask price difference is much smaller. While the FX market is believed to have significant liquidity because it is open 24 hours a day, the stock market is more complicated. In the stock market, liquidity varies widely between individual stocks. A stock with insufficient volume will have low liquidity, since it cannot be purchased and sold as readily as a stock with high volume. Meanwhile, the stock market sees fewer deals per day than the bond market, but it is still very liquid. When trading in smaller shares that aren't part of the popular blue-chip universe, though, investors may run into problems. Even though a country's money supply fluctuates, there will always be a huge currency to trade. Because all big currencies are highly liquid, the price sensitivity of stocks and Forex is very much different. But buying 10,000 shares in stock can impact the stock price. Eventually, it will be powerful for smaller businesses with fewer outstanding shares compared to companies like Apple. On the other hand, the Forex trades of $1 million in a strong currency will certainly have little effect on the currency's market price. There is far too much supply for any transaction to make a significant difference. Diversification. It's a good idea to diversify your investment portfolio to create a safety net in case one sort of investment fails. There are thousands of equities to trade on the stock market, but only 27 major currency pairs to trade on the Forex market, formed from 8 currencies. Non-major currency pairs can also be exchanged, albeit fewer than 100 of them. Keeping track of 8 major currencies is arguably easier than keeping track of thousands of different stocks. Finally, Forex traders can get to know several pairs to grasp better what works for them and their trading style. Long-term trading or investing is forward thinking. Usually, some traders fail to manage to spend all day pouring at data. Maybe you're still working at a regular job and want your money to work for you. Long-term traders who wish to keep a position for months or even years will benefit from stock trading. This type of trading frequently necessitates many funds to protect your investment amid severe market swings. Stock trading in this manner can be quite successful. Imagine buying Apple stock when it first went public in 1980 and holding on to it long after the iPhone was released. Leverage. Traders can use leverage to make more revenue with less capital. It's an investment strategy that involves borrowing money to boost an investment's future return. As a result, when a trader places a trade, the broker can multiply it. Assuming leverage of 1 to 10, the broker can reproduce the size of your deal by 10 times. It allows you to make more money even if you have limited resources. However, you may find yourself on the losing end of the equation, incurring far more losses than you can afford to repay. Traders with a margin account can utilize up to 2-to-1 leverage in stock trading. However, day traders who initiate and close their positions in a single day and have a balance of more than $25,000 can trade with up to 4-to-1 leverage. Before you can accomplish this, you must meet specific prerequisites. A margin account, which you need to leverage in the stock market, is not available to everyone. Now, both stock and Forex trading use leverage, but Forex uses more of it. When deciding between stocks and Forex, this is a crucial risk assessment element to consider. Forex versus stocks. Which one is better for you? Forex relatively lacks regulation, but it offers leverage to a great degree that makes it simple to manage massive trades. A novice Forex trader can access the same tools as the experienced trader in the market. In contrast, in stocks, a trader should obtain particular certifications and save a lot of money to trade. Forex trading is for you if you want to start selling significant amounts of money right now. While stock trading is a little easier to understand, while a larger economic context is always beneficial, purchasing stock is a basic concept, as you're purchasing a portion of a company's ownership. Combined with the significantly regulated environment, some traders might relax and concentrate on their future trading plans. But short traders can experience risks, as stock trading entails additional risk because of the way currency pairing operates. You can profit by shorting it when the stock market falls, but this comes with other dangers. Shorting a stock carries the danger of potentially limitless losses. But that isn't very certain because the broker certainly goes for ending the short position. Nonetheless, most financial counselors advise to not be short, and most experienced investors use limit orders and stop loss to mitigate risk. Final verdict. Trading in the Forex market offers numerous advantages over trading in the stock market, making it more available to the vast scope of people due to its flexible hours, reduced fees, and bigger trading volume. However, if the stock market suits your personality and you are interested in investing or longer-term trades, then you can go for investing in stocks. Both markets demand some of the same abilities and very distinct ones. Neither is ideal for total beginners, though Forex can be preferable for traders who are just starting with small cash. But if you want to trade and invest in both, you need to conduct research and study tactics before deciding which is the best market for you. While most investors are more familiar with the stock market than the Forex market, this familiarity can be comfortable. Others will appreciate the high risk or reward ratio that comes with trading in an unregulated foreign exchange market with high leverage. Whatever you prefer, trade with caution and utilize stop losses to keep your risk to a minimum point. Hope this video will help you to understand both Forex and the stock market. So, which one do you prefer? Don't forget to share your thoughts with us in the comments section. As always, thank you so much for watching. Please subscribe to the channel, like the video, and press the bell icon for more amazing content about wealth management and finance-related videos. Success is coming your way. Keep your doors open. See ya till the next time.